And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Bank ETFs are in focus right now. The regional bank ETF down 32% this year on the heels of what started as a concern over depositor flight and also higher deposit costs, and is now morphing into a concern generally over credit, particularly in commercial real estate. So where is all this money flowing? Let's talk to Reggie Brown. He's the principal of GTS, one of the world's largest market makers. Reggie, in particular, heads up ETF trading. And Kevin Simpson, he's portfolio manager at Capital Wealth Planning. Reggie, good to see you as always. The S&P Financial ETF is down 5% this year. But if you look past that, you look at the basket of the KBE, which is money center banks and regional banks, down 24%. The regional bank ETF, KRE, down 32%. Sort this out for us. What's going on?
Well, KRE is net losing assets. If you look at the entire suite of regional bank ETFs, they're picking up assets. And I think a lot of it is two drivers. One, valued players coming in to buy. KBWB is a Vesco ETF, is one of them. Pick up a ton of assets over the last 3 weeks. But also, I think there's a bunch of short sellers in the marketplace that are looking to borrow shares, and thus creations go up and shares outstandings go up. So I think it's a two-sided equation here.
Yeah, it's a little confusing for people. So these regional bank shares are dropping fast. But as you mentioned, there have been notable inflows into the regional bank ETF, KRE. Their shares are being created. That's an equal weight basket of the large regional banks. So the inflow, the shares are being created because why? Short sellers are piling in, and the market makers are having to create new shares to account for these short sellers who want to sell this. And
exactly. Listen, ETFs are dynamic, and what's under the hood is very important here. And as you say, the individual stocks are dropping fast, but all of them are not in trouble or have problems with their balance sheet. And I think the sector is probably in focus for advisors to start piling in certain areas.
Yeah. Kevin, any thoughts on the banking situation? The current concerns are, as I said, it seems like it started as a deposit flight worry, but it's a lot broader than that. They've expanded now. We have higher deposit costs in general is an issue. There's the prospects for more regulation for these regional banks. And most importantly, as I mentioned, these credit issues, specifically around commercial real estate down the road.
Well, yeah, I think you hit the nail on the head, Bob. But the one I'd be most concerned about are the regulatory issues, because that's a given, and it's not going to be isolated just to the small banks or the regional banks. It's going to affect banking in general. And from that lens, you have to assume that earnings are going to come down a little bit across the board, much more so, I think, with regionals and super regionals than with the major banks. But in the ETF we manage in Devo, we own JP Morgan and we own Goldman Sachs, and certainly to the extent that we've seen deposits going to JP Morgan, I think that's been a strong positive development. But we can't ignore the commercial market that you mentioned. And I think, again, just to restate it, I think the regulatory issues are going to be the big across-the-board problem.
Yeah. Now, you mentioned Devo. Let me bring that in here. You run, this is a slightly different issue, but you run the Amplify Enhanced Dividend Income ETF. The symbol is Devo, D-I-V-O. It's an actively managed ETF. It provides income by, it selects stocks from the S&P 500 index, and you overlay it with a call writing strategy, essentially. And this goes along with a kicker. This was a big hit in 2022. Explain for people who don't understand how these things work, what Devo does.
Well, I'm only going to speak on Devo because when we talk about option strategies, you can get a little wonky and get into the weeds. But for us, we like to keep it simple. We own 25 to 30 best-of-breed blue chip stocks. I know best-of-breed is somewhat relative, but we allocate across all sectors, Bob. So we're looking for companies that, simple, they make money and they distribute cash flow to shareholders. So we're looking for companies that pay dividends, but really more than that, we want strong, powerful dividend growth. And I think that's more than anything the fuel that feeds our engine. The covered call piece is implemented as a means of harvesting volatility to protect a little bit of the downside. And we tactically sprinkle in some short-term out-of-the-money covered calls. But to your point, from a popularity standpoint, when interest rates were very low and we sat in a near zero interest base for a very long time, over a decade, anything that you could do to enhance cash flow became very popular. And you saw a lot of strategies pop up that really tried to pump up the yield. Ours is a modest cash flow. We shoot for 4 to 7%, much of that coming from dividends. And really, it's a risk-adjusted total return strategy.
Right. So these covered call strategies were kind of hugely popular last year, and I guess it's great. You collect some income, and that's how you kind of outperform. But the downside is it's great in a down market, but if the market keeps rising, you're essentially giving up upside, right? Because you're selling covered calls.
Yeah, admittedly, when you introduce covered calls to a strategy, you're going to be forfeiting some of the upside. And when we look at Devo, we're thinking about how can we capture 80 to 90% of the rising market and limit the drawdown and the participation in a down market to 65 or 75% by tactically looking at covered calls. And literally, we get criticized for being frugal on the option writing at times, but what we're looking for is we want to participate in rising markets, dial back on the option writing, and then when you have volatility, kind of put the pressure down, take advantage of it. Covered calls work best when you need them to most, Bob, in periods of higher vol.
Yeah, and you also run an international version of Devo, IDVO, and you own some big names in here. You own Petrobras, for example, the Brazilian energy company, which is similar to Exxon, but I gather you think it's significantly less cheaper with a big dividend. What is it? What is the dividend? It's like 20% now. It's crazy, right?
I don't even believe it. I mean, literally, I look at it, I send it to you in the notes, and I'm like, how is this even possible? But they've been increasing this dividend at a very rapid clip over the past 5 years. It trades with a 3 multiple, like, no joke. And the dividend's close to 20%. And you have to be careful with international stocks. I mean, it's not Exxon.
Yeah.
And there are lots of variables that go into it. And they raise their dividends and lower them. I mean, it's not a stagnant dividend by any means with any of these companies, but that's a heck of a yield, huh?
Yeah, and I know it's crazy, but it went ex-dividend just recently. So, and you also own Tencent, the China communication company. It's a lot like Google here, but again, it's cheaper. What is it, 14, 15 times PE? This is why a lot of people like China as a value play. Yields are about 4%. It's been growing 25% in the last 3 years. I don't know what the sales growth is. It's over 10%, I guess. And cash flow earnings over 20%. So you can get, I get the value play here.
If you believe what they tell us, it's coming out of China, so you take it with a grain of salt.
Yeah.
But our theme in this international play, Bob, is that the second half of the year is a China reopening story for international names. If the dollar levels off, and that's kind of a thesis we have where it's outperformed for 12 years, and it doesn't have to pull back, it just has to level off. And then you also look at the fact that some of these international stocks specifically might be more attractive than American stocks when you think of a Chinese consumer. But that's a conversation for later.
Yeah. Reggie, any thoughts on the popularity of these covered call ETFs? They were just a huge hit last year. And like I said, in a sideways down market, they're great, but you're giving up something.
Well, first of all, they're complex. So it's pretty important for advisors and retail mom and pop to understand what they're buying into. On the whiteboard, there are a number of strategies coming into the marketplace. I think they fit a purpose, and they've worked remarkably well. Bruce Bond was first to introduce a cover called buffer strategy under his lineup, and then bring competition to the marketplace and drop fees down significantly. So I think there's a lot of opportunity to bring innovation and value to a segment of the population around covered calls and input strategies, and they're coming. So yes, they're complex. It's really important to understand how they're built, how to use them, but there's a purpose for them.
Yeah. I want to go back to the bank story because the viewers are really sort of confused about this. And one of the key points that I always point out, and bank analysts have been pointing out, is banks have not been very good returns on investment for a long time. I was at a conference yesterday, a charity event, and one bank analyst said to me, the owners of bank stocks are asking, why am I here to begin with? And he meant by that a lot of investors have not been compensated for owning bank stocks or bank ETFs for many years. We bring up this regional bank ETF, the KRE. It began trading in mid-2006, but look at these numbers here. Since its inception, it's down 20%. Down in 17 years, it's down 20%. And these banks have never really recovered from the great financial crisis. And since then, as you see here, the S&P 500 is up 230%. These are like airline stocks. They're like heartbreakers for years and years and years. So it's not like this particular crisis suddenly destroyed a super investment opportunity for people.
Listen, banks are essential to the American economy.
Yeah.
And so for investors to lend capital to them for their operations for return of capital, look, they're great dividend payers. Look at Apple. They just introduced a savings account. They got $1 billion reported in a short period of time, over 240,000 accounts paying 4%. And I read this all in the newspaper. I'm not close to them. And so if you look at the demand for yield, banks provide a service. Yep. But as far as the composition, it's risk adjusted. Investors have to make their decisions.
You know, that's a very good point about the dividends, because we tend to put these up, and we make this mistake with the S&P 500. We don't include total return.
That's correct.
In them, and that is a very serious error, because as you know, just in the S&P 500, if you go back 20 or 30 years, it's a significant component, dividend, of total return. So if you get a bank stock that's doing 3% a year, and you compound that interest, sure, over time, you may get a much better
Well, the
return.
dividend yield, S&P 500, is around 178 basis points, or 2%. So if you're long the S&P 500, it gets you 230 basis points of returns plus dividends. It's pretty significant.
Yeah. Kevin, we are in the middle of earnings season right now, and it's been kind of strange. They were dropping estimates rather dramatically going in. In the last couple of weeks, as we're in the heart of earnings season, the numbers are coming in much better than expected. So the estimates for the first quarter are now actually going up again. And in the second half of the year, they're fairly stable. So while there's an earnings slowdown, there's certainly no recession, an earnings recession going on. In a real earnings recession, you know this, earnings will go down 10, 20, 25%. We're basically flat for the year on expectations for the S&P 500. Any thoughts on what this earnings season is telling you and what you're telling your clients?
Yeah, I mean, when we look at the earnings beats don't mean what they used to in the old days, because we know where the bar gets set. We've got to do everything we can to beat it, or at least come close to expectations. So what I'm listening for on every single earnings call is what the folks are saying about the rest of the year. And we're not seeing, material increases on the rest of the year. Now, to your point, Bob, we're also not seeing the drop-off, which is a good positive sign. But what I'm hearing consistently is that companies are reducing expenses and they're reducing investments. So if they're planning for a slowing economy, I think we really need to pay attention to that, because there's consumer spending, business spending, and government spending. And I think what we're seeing this particular earnings season is the yellow light that businesses are tightening the belt just a little bit. And again, that's not a precursor to a recession. It doesn't have to happen. That's what I'm hearing.
And I wonder if you can comment on the overall trading situation and the situation with the VIX. So you're at GTS, it's one of the biggest market makers in the world. You see an awful lot of flow. One of the things that's striking to me is the volumes can be very light on certain days, considering how edgy things are. And the VIX is remarkably sitting at 16, 17, I think it's 18 today. But, historically the VIX is 20, 21, 22. If it gets up 28, people start paying attention. But when it gets down to 16, that's sort of remarkable. From your position at GTS, how do you account for the somewhat lower trading volumes that are sort of expected in certain areas, and volatility being so low, given all the anxiety that's out there?
Well, I think even another measure, there's a new measure around one-day VIX, and that's even lower. There's no fear in the marketplace. I think all the information is in the marketplace, and advisors and retail players have a good understanding about what to expect, and they're watching this one sector. I think there's no fear. The overall ETF industry this year to date, has accumulated over $700 billion of new assets, and you're seeing just people piling into ETFs like iShares Quality, and then the S&P 500 complex across the board. But look at Europe. Europe is up 12% year to date.
I want to talk about that later.
It's just, you're just seeing just pockets of opportunity, and I think that with the marketplace, there's no particular fear. And so there's not a lot of trading frequency because long and land is fine.
The viewers seem very confused about the VIX. They keep saying, how could it be at 16? That's really, that's a new low. And why are people so complacent? Why aren't they more fearful? Don't they know there is a recession? But the VIX, we point out the simple fact, It's only a 30-day indicator,
That's
the
correct.
one that we use. If there is a big event 31 days out, it will not show up in the VIX. And you have to explain that to people, because it's not a recession indicator. It's not in anything. It's just an expectation of volatility in the next 30 days. And if they don't think there's going to be a big event in the next 30 days that's going to alter what's going to happen, it will not be, it will reflect that. But beyond that, it won't reflect anything. It's not measuring anything beyond that.
But that's index vol. If you look at individual company volatility in some of the bank sectors.
Oh, yeah, huge.
The volatility is north of 100. You know, if you look at some of these individual names.
Oh, yeah.
And it's even tough as a market maker to sell into that because it's illiquid to get out. And so I think that overall, yes, volatile is low. Individual names, not the case.
Yeah. We've seen trading volumes in the regional banks 5, 6, 7, 8, 9 times historic norms on a daily basis. You know, banks that trade 3 million shares a day, trading 20 million, 24 million shares a day. Enormous. We're going to get into this a little more in our podcast, but I'm going to have to stop right here for this week's ETF Edge. My thanks to Reggie and Kevin. We've asked Reggie to stick around and give us his thoughts on broader ETF trends, including what's going on in Europe. Very interesting over there. This is for the ETF Edge podcast, a portion of the podcast. And remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.